16, that's true. All right. The questions are A, prepare worksheet for correction of net income. So we have now the answers to requirement letter A. We have the net income in 2020 in the amount of 3 million and 2021, 4 million. Then the December 31, 2020, the inventory was understated. So meaning we have to add to 2020. We have to add to the net income and deduct from 2021. The fact that on December 31, 2020, the ending inventory on that year was understated. So cost of goods sold was overstated. And so the net income was understated. So we have to add back. In 2021, because of the understatement of the December 31, 2020 inventory, which was the beginning inventory of 2021. So the inventory on January 1, 2021 was understated. So the effect of that on cost of goods sold understated, we have to correct. And finally, net income was overstated. So we have to deduct back. Now, likewise, on December 31, 2021, the inventory again was overstated. So that for 2021, we are going to deduct 18,000. And the other effect will be in 2022. The depreciation for 2020 was understated by 4,000. So that means that the net income was overstated. So we have to deduct from net income. Prepaid insurance. Insurance premium for 3-year period was charged to expense on January 1, 2020. So that the entry in January 1, 2020 was to debit insurance expense for 15,000 and to credit cash. Now there was an overstatement of insurance in 2020 because supposed to be 10,000 should be recorded as prepayment. Now that's taken by dividing 15,000 by 3. 5,000 is the correct expense and 10,000 is the prepaid. So you have now to add back 2020 net income. However, we have to deduct from 2021 and even to 2022 net income. Then we have the gain on sale of machinery, which was sold for 32,000. I mean, the carrying amount or the book value is 200,000 on December 31, 2021. But the sale was not recorded until 2022. Supposed to be the entry in 2021 by December 31, 2021, debit to cash 32,000. And we have the amount of the carrying value of 200,000. In other words, there is a gain on the sale for the amount was not recorded until 2022. Now, since the equipment has a carrying amount of 200,000 was already fully depreciated on December 31, 2021, the full amount of 32,000 is considered to be a gain on sale of machinery. So we have to add to 2021. Now, for the corrected net income for the 2 years. For the second requirement, adjusting entries on December 31, 2021. First, we debit the inventory on January 1, 2020. 2021 for the understatement and credit to retained earnings, assuming that in 2020, the books are already closed. Then in number 2, we debit to income summary and credit inventory on December 31, 2021 in the amount of 18,000. This was an overstatement. Then number 3, debit to retained earnings and credit accumulated depreciation in the amount of 4,000, being a correction for the understatement of depreciation, but we finally debit to retained earnings, assuming the books are already closed. Now that is for 20,000 and the books are really closed. Then number 4, we debit to prepaid insurance and debit insurance expense, credit to retained earnings. Now for the prepaid insurance paid on January 1, 2020. Then the number 5 and 3, debit to cash, debit to accumulated depreciation, and credit to machinery for 200,000. Now, the machinery was fully depreciated. So, 200,000 minus 200,000, meaning the 32,000 is a gain on sale. Next, we go to problem 16-4 before we go to the multiple choice. Now, in 16-4, the problem has two requirements. Determine the correct net income for 2021 and prepare the adjusting entries. So we are now given the income per book of 6.5 million and we have the following corrections. Now, the unrecorded merchandise purchased in 2021 but included in the ending inventory. If the purchase was recorded only in 2022. So we have to deduct from the income per book because as the effect of the error was to understate cost of goods sold. So income was overstated. So we have to deduct. Then we have the understatement of ending inventory. A merchandise shipment valued at 1.5 million was properly recorded as a purchase at the end of the year. So we have now 1.5 million understatement of the ending inventory. Now that is to be added to the ending inventory. Then for the unrecorded accrued advertising, since advertising on December 31, 2021 amounting to 500,000 was recorded when payment was made on January. So we have now the amount of advertising unrecorded accrued advertising in the amount of 500,000. Payment was made in January. That was the time when the expense was recorded. However, it should be recorded in 2021. So what happened? Due to the failure of the company to record advertising accrued, the net income was overstated. Next, we go to rent of 300,000 on equipment applicable for 6 months was received on November 1, 2021. The entire amount was recorded as income upon receipt. So the entry upon receipt was debit cash 300,000 and to credit rent income. Reported as income. However, out of 300,000, if you divide it by 6, it's 500,000 a month, so that the earned portion is only we have 300,000 divided by 6, it's 50,000 a month. November, December, that's 100,000. So the prepaid portion for the rent, the unearned rent is the amount of 300,000 times 4 over 6. So 4 over 6 because the collection was November 1. So November, December, the earned portion is only for 2 months. Unearned is 4 months. So the unearned is 200,000. So now we have the prepaid insurance covering the period July 1, 2021 to July 1, 2022. So it's a period of 1 year. The payment of 200,000 was paid and recorded as expense on July 31, 2021. The entity did not make any adjustment at the end of the year. So the expired portion is from July 1 to December 31, the 6 months. The unexpired portion is also 6 months. So the corrected net income of 6.4 million. Now for the adjusting entries as required in the problem, for December 31, 2021, we debit to purchases 1 million and credit accounts payable for 1 million. Then debit the inventory and credit to income summary. So the inventory was not recognized in the amount of 1.5 million. So we now credit to income summary. Then in the case of number 3, we now debit to advertising, credit accrued expenses, the amount of the unrecorded accrued advertising. Then followed by rent income, the amount of rent income and earned portion is 200,000. So we have now our unearned income to be adjusted for the amount of 200,000. Debit to rent income and credit unearned rent income. Number 5, we have the prepaid insurance. So debit to prepaid insurance, credit to insurance expense in the amount of 100,000. Now the rest will be in multiple choice. So I'm going to discuss multiple choice problems 16-5 up to 16-21. So let's now begin with the 16-5. 16-5. And what is the requirement? What amount should be reported as corrected income before tax? So we now begin with income before tax per book equal to 5 million. Then we add prepaid insurance end is 200,000 and accrued wages of 250,000. We have now your accrued wages. And then we have rent revenue collected in advance for 300,000. And we have interest receivable for 100,000. Now, some of this increase income, some decrease income. So corrected income before tax is letter A. Then we go to number 6. The problem is at what amount should retained earnings be retroactively adjusted on January 1, 2022. Now we have the 2020 and 21 records of the financial statements. So we now go to 2020 and 2021. The 2020 inventory was understated for the ending inventory, and the 2021 it's overstated. So we now have the corrections. 2020 we add 200,000 and deduct from 2021. The 2021 inventory overstated. So we have to deduct from 300,000. And in 2020, depreciation was understated. So we have to add and deduct 50,000 more. 2021, depreciation was understated. So the answers B and number 20, we have the amounts in 16.6. The answer is B for 150,000 ang aton nga net correction. So the net decrease retained earnings of 250,000. That's letter B. Now for the corrections to retained earnings in 2021. When we have the net correction of 400,000, the net income in 2020 for 150,000. Okay, now in problem 16-7, prior to any adjustments for the errors and ignoring income tax, what amount should be reported as net effect of the errors on retained earnings on January 1, 2022. So for problem 7, we are now asked to show the effect on the errors on retained earnings. So for 2021 and 2022 finally. So in 2020, inventory understated. So we have to deduct from 2021. In 2021, inventory overstated. So from retained earnings, we have to deduct. Then we have the net correction. In 2020 further, we have the net income under net income in 2020 understated. We have net income of 2021 overstated. So the net effect on retained earnings is 75,000, which is negative. Then we go to problem number 8. The question is, if none of the errors were detected or corrected, what amount should be reported as net effect of the errors on retained earnings on December 31, 2021? So in problem that's 8, we have now the 2020 and 2021. Take note that we are asked for the effect of the errors on retained earnings on December 31, 2021. So the ending inventory of 2020 was overstated. If overstated, cost of goods sold was supposed to be understated. In 2020, the ending inventory is overstated. So you are deducting a bigger amount in arriving at cost of goods sold. So what happens to your cost of goods sold for the 2020? We have to deduct further from retained earnings. But in 2021, we have to add. The ending inventory of 2020 becomes the beginning of 2021. 2021. So if the beginning inventory was overstated in 2021, cost of goods sold was overstated. So finally, net income was understated, and so with retained earnings. That's why we have to add two retained earnings. In 2021, the inventory was again understated by 200,000. So the ending inventory of 2021 is understated. So the cost of goods sold was overstated. So that net income was understated. We have to add back the same with retained earnings. Now with rent expense understated at the end of 2020, meaning the prepayment was not correctly recorded. So if none of the errors were detected or corrected, what amount should be reported as net effect of the errors on retained earnings? Now, the rent expense of 2020 was understated. Since understated, net income was overstated. So we have to deduct further from retained earnings. In 2021, rent expense was overstated, net income was understated. So we have to add more. Now, net effect on retained earnings on December 31, 2021 will be 450,000 minus 200,000. So it's now letter B, 250,000 understated. Next, we go to problem 16-9. There are three requirements. One, what amount should be reported as net effect of the errors on 2020 net income? So the effect of the errors on 2020 net income. Now in number one, the answer is letter A. So that answers the amount letter A, that's 250,000 understated for the net correction. Then in 2021 net income, what's the effect of the errors? In number two, in 2021, the answer is B, 300,000 overstated. So we have to deduct. And finally, in number three, what's the final effect on retained earnings on December 31, 2021? So that's now for letter C, for 50,000. Now we go to question number 10. And the questions are net income, ignoring income tax. What amount should be reported as net effect of the errors on net income for 2020, for 2021, and retained earnings on December 31, 2021, and finally on working capital. So let's begin with the 2020, the number one requirement. The answer is B, with the 200,000 under statement. In number two, the net income for 2021, 300,000 over stated. And the effect in number three on retained earnings on December 31, 2021. The answer is 100,000 being an overstatement. And on working capital in number four, that's letter A, in the amount of 40,000. Now you have the supporting computations in connection with the solutions. Then we go to number 11, has two questions. Rebecca Company revealed the following information on December 31, 2021. What amount should be reported as adjusted net income for 2021? And requirement number 1, our answer to 16-11, requirement number 1 is letter A. That's 3,830,000. That's for the adjusted net income for 2021. Then for question number 2, the answer is A for 14 million. That's the retained earnings on December 31, 2021 for question number 2. Then we go to 16-12. As a result of the errors, what amount should be reported as net effect or net income for 2021? So in number 12, the answer is a 240,000 overstatement, net correction to income. And number 13, we got two questions. Question number 1, the answer is D, 250,000 understatement, net effect on retained earnings. And question number 2, the answer is 0, the current assets on December 31, 2022 are no longer affected because the overstatement of 2021 ending inventory would affect 2022 cost of goods sold. Depreciation error does not affect current assets. So in question number 2, we have a 0 effect. Then we have now number 14. 14 with question number 1. On December 31, 2021, fully depreciated machinery was sold for 100,000 cash, but the sale was not recorded until 2022. What amount should be reported as net effect of the errors on net income for 2020? So the answer to number 1 is A, number 2 B, and number 3 D with the computing, with the supporting computations. So in number 1, it's 250,000, an understatement. In number 2, it's 1,150,000, an overstatement. And question number 3 for letter D with a 900,000 overstatement. Next, we go to problem number 15. Now, 15 with again several requirements. In number 15, we have 4 requirements, and we have now number 1, what amount should be reported as net effect of the errors net income for 2020? So in number 15, question number 1, the answer is D, 5,000 overstatement. Question number 2, the answer is A, that's 16,000 understated. Question number 3, the answer is A, 11,000 understated. And question number 4, on working capital, the answer is D, that's for 6,000 overstated. Then we go to number 16. What amount should be reported as net income for 2021? And question A is 2,600,000 50,000. Net income per book, then overstatement to beginning inventory, we have to add back to the net income. Overstatement to beginning inventory will likewise overstate cost of goods sold. So decreases net income. That's why we have to add back. With the understatement of the ending inventory for 500,000, if the ending inventory is understated, cost of goods sold was overstated. So net income was understated. We have to add back. Then we have the unrecorded insurance for 2021. So expenses were understated. Net income overstated. We have to deduct 50,000. And the cash advance credited to sales, it overstated sales. So we have to deduct the effect on net income. Then with number 17, the question is, what amount should be reported as net income for 2021? So we have now the net income per book as given, and we have the overstatement of inventory in 2020. We have the overstatement in inventory and another overstatement in 2021. So we have to deduct from 2020 add to 2021. Now the error is already counterbalanced. However, in 2021, we have to deduct 150,000. The revenue received in advance, it's not yet earned. It's advance collection, so meaning it's unearned. We have to deduct from 2020 and add to 2021. Gain on sale of equipment for 400,000. So we have now the corrected net income in problem 17. We now go to problem number 18. What amount should be reported as net income for 2021 in problem 18? So net income reported in 2021. In 2021, so we have now net income reported in 2021 for 1,550,000. Then prepaid insurance, we add inventory on January 1, 2021, deduct, and the inventory in December 31, 2021, add, and accrued taxes, deduct, and advances from customers end. So we have now the corrected net income for number 18. So that's question. The answer is letter A. Next for number 19. If in the 2022 financial statements, the December 31, 2021 retained earnings balance as previously reported should be adjusted by what amount before tax? So we have now the amount in letter C, 150,000 credit. And we have now 16 plus 20 and 21 for the multiple choice theory. Now that ends our discussions of chapter 16. Now